leverage can be used against you, and there's nothing bigger than the market. Okay, you are not bigger than the market. So we just got to understand that. Okay. Now, Mike, haven't gone through that. Let's go through the structure of a radioactive profit machine, which I believe is the proper way to set up a married put trade. Okay. You see, here in this zone, we've got green is that stock going up, and red is the stock going down. Now, Mike, if you just own the stock and she goes down, your losses are 1-to-1, right?
Mm-hmm. That's right.
All right. But with the put option protecting you underneath, and we're going to get to some numbers here in just a minute, but I just want to get concepts out of the way. Let's go click that screen and look at the break-even line.
Mm-hmm.
Okay. What we have here is a structure that if we buy the stock and also buy a put option, there's only a very small amount that can be lost. Click it one more time. This this area here between the dashed line and then the hard bottom there, the hard line at the bottom, that's your floor. Okay. But then on the other hand, your profits can be unlimited. Okay.
Mm-hmm.
So let's go ahead and take a look at your SLW trade here, Mike. We've got SLW shares. Now, you picked this up on May 21st.
That's right. Now, do you want me to transfer over to the other slide at this point, the other slide presentation at this point?
No, let's go ahead and stick with this for now, and then when it gets to income method 4, can we swap over?
Okay.
Does that make sense?
All right. Yeah, that's fine, Kurt.
Okay, cool. And you know what, Mike, I bet you got something pretty slick. But I know my talking points on this part, so let's go ahead and start here. All right, so SLW, you picked it up at $17.20 a share.
That's right.
Okay. And at the same time, you picked up a December, now that's 7 months out in time, a December $20 put option for $4.30. Now, what was the objection that you gave me when I told you that this is how I trade, and you looked at that and you said, well, I don't know about that.
Well, the first time you called up, yeah, the first time you called up and you asked me how to find these positions historically, and I saw what you were doing, I thought that, well, this doesn't make any sense to me. You know, usually when you do a protective put, you buy an out-of-the-money put that's 1 month out for a low premium. In this case, you're adding $4.30 on top of the position, and, you know, you'd have $21.50 invested. You're not going to make a dime until the stock's above $21.60. I don't know why you would do this on a stock trading at $17.
Right. And that's the argument that I hear a lot of times, Mike. But let's go through the math.
Mm-hmm.
The total invested there is the $21.50, and we're guaranteed to be able to get out at 20 if something goes horribly wrong. So the amount at risk is $1.50. Now, out of that $4.30, we're going to get most of it back. So is it really that expensive?
Right. The cost for us, the time value cost, is only $1.50 on the position, which works out to be 7% on this particular trade. And this is the initial setup. This is the setup that we use every time we open stock. This is the radioactive profit machine. We're going to purchase shares of stock and look to purchase the in-the-money put option several months out in time. And, of course, the philosophies behind why we're setting it up this way are described in the blueprint.
Right. Now, Mike, you've been in silver wheaton since May. Can you imagine trading silver wheaton with a 7% stop loss order?
Well, it'd be a tough position to do, especially if you got into it recently, because the stock tends to move a little bit. Silver wheaton has a little bit of move. It's in the right industry right now, but with a 7% stop order, which is essentially a market order, telling the market, hey, get me out of this position as soon as this is triggered, and then you don't have any say in it. Now, if silver wheaton goes down in price from this initial entry point on May 21st, I can choose to close the position and take only a limited risk, or I can choose to make adjustments and continue to make the trade.
That's right. Now, another argument, okay, another argument is that we're starting underwater. For example, you bought the stock, you bought the put, man, you just lost 7% because the 7% is what's at risk, right?
And that's right.
Is that how it really works out?
Well, no, because first off, I'm not going to realize the 7% risk unless I hold the position all the way to expiration and make no adjustments. As the
Right,
stock
and
moves,
the stock goes down.
and the stock goes down. If
Right.
the stock stagnates, that put's still going to retain a lot of its value. So I'm not going to realize the 7% loss until closer to the expiration date if the stock moves down. But if the stock moves up, I can not only do certain income methods that we're all probably familiar with, just selling a call against it to generate some income, but I'm also going to be able to take advantage of adjusting the put if the stock goes up or goes down.
That's right. Okay, and then you're getting into income method number 3, 4, and 9 there.
Mm-hmm.
But the fact is, a lot of folks believe that once you buy the stock and the put, it's like driving a new car off the lot. You know, when you drive a new car off the lot, it loses 20% of its value just like that.
Mm-hmm.
But honestly, Mike, moments after you entered this position, you could close it for about the same.
Yeah,
right?
I could have sold the stock for about I could have sold the stock for about $17.20, and I could have sold to close my put for maybe $4.10, $4.20, for example, and only lost 10 or 15 cents.
Right. Okay. So that total amount at risk, that $1.50, that's the maximum over a period of 7 months. It's like you're paying about 20 cents per month for insurance policy.
Mm-hmm.
Okay. But let's see what happens. Okay. Let's take a look at the next screen. You see, we start out with it there. When I say we, I mean Mike. This is Mike's trade. And then silver wheat went up.
Mm-hmm.
Okay. And then next page, we're going to have income method number 1. Now, income method number 1 is selling a near-term covered call. You've got insurance all the way out to December, right?
That's right.
Right. And what you did was you sold a covered call, and what was the strike price?
It was the 21 strike. I believe I sold it on 6/28 when the stock was trading at around $20.50, about $20 per share.
Okay. Now, your total amount invested for both the stock and the put was $21.50.
That's right.
So by selling this call, you generated a little bit of income, right? Let's go ahead and see. It was $1.48. And by doing that, you took on the obligation temporarily that you would deliver silver wheaton at $21 if it was trading higher than that. Right?
That's right. Mm-hmm.
Okay. But what is our cost basis? I mean, the cost basis had been $21.50. Now it's $20.02. Okay. So if you deliver those shares at $21, do you make a profit?
Yes, I would have a profit, and I'd still, even in addition to the 98 cents, because I'd get called away at 21, in addition to that, the put would still have value in it as well.
Right. The put option itself would still have some worth to it. So you're looking at definitely, a 5 or 6, 7% return.
Mm-hmm.
I mean, I see about almost 5% in selling the stock at 21 and keeping that premium. Okay. But you could also sell your put and do better.
Mm-hmm.
But, Mike, what happens is you've got a guaranteed exit. You can get out of the stock for $20 a share, and your new cost basis is $20.02 a share. So what's your risk?
Well, the risk is 2 cents on the position. I'm only risking 2 cents now after one adjustment.
Poor baby. Okay, so so that's the first adjustment. Okay, that's income method 1. And that doesn't necessarily mean you don't have to do them in order, do you, Mike? You don't have to do 1 and then 2 and then 3.
No, absolutely not. It's based on what you call the SIGA model for each position. Now, at this time, when I did income method number 1, there was also an opportunity to start off with income method number 4. That we might show in a couple minutes. And income method number 4, I could have done a little bit differently. I wouldn't have exactly bulletproofed the position, but I might have been in the same situation with an unlimited upside profit. I think I would have been risking